is we talked about first cornerstone of value creation, which was spread. And we said that about half the spread was the industry. And we used a very specific definition for attractive industries. There it is. And we're kind of following what I call Warren Buffett's principles. So in this class, our definition of an attractive industry, value creating industry, is positive spread. ROIC against WACC. So to be an attractive industry, it has to be a value creating industry and it has to have a positive spread. Our definition of competitive advantage that we're using in this class is performance relative to peers, specifically spread against the industry. So we're defining the industry as the peer group of publicly traded companies in the industry, and your relative performance against them is whether or not you have a competitive advantage, which leads to two special cases. You can actually have an industry that's destroying value, think autos, but still have competitive advantage because you suck less than everybody else. Okay? So essentially, one way to have competitive advantage is just, even though the industry is horrible, we're just less horrible than everybody else because we're better at what we do. The opposite is also true. You can have a phenomenal spread and create a lot of value, but you're not creating as much value as everybody else, so you're just in a good place. You're not necessarily the better company. Okay? So again, relative performance to peers, competitive advantage, absolute performance spread for the industry, attractive, unattractive. Okay, so how did we do this? Let's practice one more time. So back to Bloomberg. This is going to be where we get Union Pacific, so I don't want you to see the actual answer, so we'll do a different company. All right, so let's do Coca-Cola. Okay. So again, once you have your account, KO, or you can start typing in COKE, but the point is, KO US Equity is their stock for Coca-Cola. RV, either type RV or select RV, is the relative valuation, performance against peers. We'll go to custom. And then settings, global settings. I don't like the top section. That's by default. You can keep it there if you want. Uncheck it if you don't want it, if you want more real estate. And then more importantly, make sure market cap weighted average is selected. There's no save. Just when you close it, the screen will update. First line will be the market cap weighted average. All right, for the add column, first column is the ROIC, return on invested capital. Just for this assignment, I want you to do it as of the latest filing. Don't do the latest quarter, don't do the latest year, don't do some customized period. I want you to do the latest filing, just so that we all have the same data. It's easy for the TAs to grade it. Because if you don't have the latest filing, you're not going to have the right industry ROIC. You're going to get a 0 on the assignment. It's going to suck. So pay attention to the rules that we're giving you. Latest filing. Hit enter. If this were the assignment, the industry at 17.54%, Coke 11.43 as of the latest filing. Next, add column WACC, WACC, weighted average cost of capital. Now this one will vary. Unlike the ROIC, latest filing, which will just go every 3 months, basically the WACC is calculated in real time. So it's going to use the yield, the maturity on the 10-year at the time you hit enter, every time the screen is loaded. It's going to use the beta of the company currently, and it's going to use the risk premium in the U.S. market currently. So the WACC will vary on this assignment. That's okay. But the ROICs should not, but they're not going to vary enough to change the answer for Union Pacific. So again, here's the ROIC, here's the WACC. Is this an attractive industry? We should all be saying yes. And we should say because 17.54 is greater than 6.23, insert a couple more words there. Does Coke demonstrate competitive advantage? No, because Coke is generating a lower spread, 11.43 minus 5.98, than the 17.54 minus 6.23. But Coke is creating value, just not as much as their peers. Okay, 250 words. Make sure it's not 248. Okay, questions? As I said, save this template. If you haven't already, up here, this little square box, take screenshot, save, name the file. It'll give you the file to submit. Make sure you submit the file. Then you're pretty much ready to go with homework 1. And then you can write the paper. Like I said, you can do the Union Pacific screenshot right here in class. If you save this template, just switch it out. Make sure you're following the instructions in the homework. All right, so continuing on. Second cornerstone. Second cornerstone is cash flow, not income. I don't have to tell you, because you're a bunch of finance and accounting majors, that basically there's time value of money, and there's a timing difference between accounting income and cash generated, when the cash is actually generated. So because those timing differences matter, and because time value of money matters, then basically valuation is cash flow driven, not income driven, right? There's a lot of stuff out there in the research you read about in the book, but basically we should intuitively understand that. So we're going to be a cash flow driven valuation class, all right? Cornerstone number 3, I'm going to spend a couple minutes on here because this one's important. Modern corporate finance was born at the University of Chicago in the mid-1970s. They wrote the textbooks, they printed the original PhDs. Everything we're talking about here, you can trace right back to what they said. Okay? Companies worth the sum of its future cash flows came from Chicago. Okay? Concept we call intrinsic value. So what they did, won a bunch of Nobel Prizes, but one of the things they did, and it's just impressive if you think about the amount of effort, in 1975 and 1976, they put together a database, 50 years, of stocks, bonds, and real estate in the U.S., anything you can invest in, thousands and thousands of assets. They put it into a punch card mainframe, pre-Excel, and basically put in cash flow and price on a quarterly basis for 50 years, 1926 to 1975. And what they found when they turned the quants loose is that there was a one-to-one relationship over time with a big data set between cash and price. Is whatever cash those assets generated over time became their actual prices in the market. And today, we call that intrinsic value. You're worth the sum of your future cash flows. And Chicago proved that it works. Because basically, eventually, you're going to get the cash that the assets generate, and you're going to buy the actual cash. And so once you know what the cash is, that's what the price is going to be. Okay? So here's the thing. You're worth the sum of your future cash flows. Well, today, what we also know is they've updated that data set through 2018, and nothing has changed. 1926, 2018, same thing, cash equals price. There's a professor at Wharton named Jeremy Siegel. He wrote a book where he went back to 1812. 1812 to 2010, cash equals price. Nothing changed. Chicago's replicated that study in Europe, Latin America, Asia, Africa, Australia, wherever you go, cash equals price. So here's the deal. I work with a company. There's a CFO of Aramark. I actually asked him this. We were in a meeting. I said, hey, CFO of Aramark, how much cash is Aramark, free cash flow, is Aramark going to generate in the next 10 years? And they're a $16 billion company, to the nearest billion. Because to be honest with you, if I'm going to price Aramark stock, I need to know the answer to that question. And he laughed. He's like, well, I guess, but it's kind of a little bit of a guess. And to be honest with you, his guess should be more educated than most of us, but that's the point. Like 10 years for a big company, it's kind of hard to guess. You got the stock price, and every one of your Bloomberg terminals is based on that guess right now. Like every price is based on that expectation. And so that's actually the challenge. So here's what's interesting. And I do this with companies all the time, and everyone's like, they laugh, they're like, ha, ha, ha. But we got to do this. This is our role as analysts. So here's the thing. Even if we guess what the next 10 years are going to be, we're probably going to be wrong. But eventually the day is going to come out, and we're going to adjust to the price. But I'm going to give you something interesting. We never get to the future. See, even if I can figure out what the next 10 years is, and I went into a time machine, the last 10 years don't matter. You're worth the future, so therefore you're worth the next 10 years. So the real problem with valuation, and there's very few always in finance, but I'm about to give you one, price is always expectation, by definition. Has to be. Because you're not worth your past cash flows, you're worth your future cash flows. We never get to that future. Whether it's stocks, whether it's bonds, whether it's real estate, price is expectation. See, the difference between fixed income and stocks is fixed income is just easier because promises are made. You issue a bond, loan, there's terms. This is how much you borrow. This is coupon payments. This is repayment date, the repayment schedule. You know exactly what's going to get paid exactly when. Right? Now, it's not 100% guaranteed because there's a default, but at least you know what the payments are going to be. Stocks, I can teach the math to an 11-year-old. It's a growing perpetuity. The math's simple. Right? It's not that hard to do the math for stocks. The problem is, what's cash flow going to be? Well, I don't know. It's uncertain. There's no promises made. So the real challenge with equity valuation is not the math. You're not going to find math to be the problem this semester. It's the art. It's knowing what assumptions to actually make because you're betting on the future. And there's a much more uncertain future with equity than within debt. So that's the point, is that we really don't know. So in the short term, guesses, long term, actual, we never get to the future. So price equals expectation. That's the third cornerstone. So it's important to understand who sets the expectations for these big companies and how do we know what they are. So buy side, sell side. What's the buy side and what's the sell side? So if I say buy side, who am I talking about? What types of firms are on the buy side? Yes, sir.
Hedge funds, asset managers,
Yeah, exactly. Because these are the people that are actually going to buy and own the stock. So it's all those types of firms that he just mentioned. So again, one of the most powerful features of Bloomberg is we'll start with Coca-Cola. So if you type in HDS, which stands for holders, go to a company, security ownership, this will tell you the institutional owners for a company on a scrollable list from top to bottom. And Bloomberg is checking SEC filings, and right now 74.2% of Coke's shareholders are institutions, and they're on the scrollable list. Right? The biggest shareholder being Berkshire Hathaway, Warren Buffett, owns 9.36% of Coke, 400 million shares. Right? Vanguard, second biggest shareholder, BlackRock, State Street, Capital Group, Wellington, JP Morgan, FMRs, Fidelity, etc. Right? But what I'm saying is these institutions which are changing these big blocks of stock, they're the price setters. Right? And by the way, this is a very important screen in Bloomberg. You work in investor relations, you're talking to the CFO every day of a public company, and you're talking to these people. And you're looking to see who's buying you, who's selling you. The last thing you want is you don't want to see somebody like a Trian or a, what's his name? The old guy. There's a real old dude who buys you, Carl Icahn, who's basically there to basically, raid you, get you to do something, the activist investors. Like this is where you start to see that they show up. So essentially you're constantly monitoring this. When you finish your earnings call, these are the next people you call because these are the owners of your company, right? And so here's the thing. I look at BlackRock, and one of the big funds that owns me, if I'm Coca-Cola, has been selling some shares. They've sold 350,000 shares recently. So I can go to this fund at BlackRock. And if I want to know information about this fund at BlackRock, I can look at this fund's holdings. And this fund, which owns Coke, is a big fund. $796 billion of assets under management. This fund has 3,864 companies in it. It's portfolio. This is the portfolio of this BlackRock fund. Coke somewhere in here. Okay? So, long story short, 15 sectors, all the competitors, 3,864 companies globally, plus all their competitors. How do I keep track of this? How do you keep track of what's going on with all those companies to make sure I can trade effectively? And the answer is I really can't. So by the way, this is what's being automated, so you're not going to have jobs in 10 years, so enjoy it while it lasts. Find something else to do. At least you're better off than like the English majors out there. But in any event, but in all seriousness, this is part of what's being automated. But what they're doing now is, this is where the sell side comes in. Right? So what's the sell side? Anybody know? Yeah. They're still on the buy side. The shareholders are going to be on the buy side. They're the banks. And the key to the sell side is they don't actually own the stock. They're your consultants. They're your consigliaries. They're the ones who are basically giving you advice. Because you can't keep track of everything, so they're the specialists. And I pay the specialists to help me figure out what to do. I don't have to listen to the specialists, but if they're good, then they're going to tell me what to do. I'm actually going to trade on them. So specifically, the sell side, you can see in Bloomberg for a company by going to code ANR. These are the analysts. And these are their recommendations. And more specifically, for Coke, it's these 31 people. It's Kevin Grundy of Jefferies, Vivian Azir of Cowen, it's Lauren Ray Lieberman of Barclays, Dara Mosianen of Morgan Stanley, etc. Scrollable list. Okay, these are the analysts that are on the conference calls that are unmuted, that are asking the questions that write the buy, sell, hold opinions. In fact, right now, of the 31, 14 of them say buy. Buys are worth 5 points. 16 say hold. Holds are worth 3 points. 1 says sell. Sells are worth 1 point. On a 5-point scale, Coke is a 3.84 out of 5. Coke share price right now is $54.92. They put in a target share price, each of the analysts, what they think Coke is going to trade at in the next 12 months. Bloomberg aggregates these, wisdom of the crowd, throws out a couple mathematical outliers. The consensus target share price of these analysts is $57.08. It's the average of the analysts' guesses. That is 3.9% upside in the next 12 months. In the last 12 months, they are up 25%. Coke is. So that's the point. What the analysts are saying about Coke, and this is a hint to your team project about finding people that outperform the S&P 500, is do you think Coke's going to outperform the S&P 500 over the next 12 months? Given this data, let's say the analysts are right. Are the analysts predicting that Coke is going to outperform the S&P 500? Unless it goes down. If the S&P 500 usually goes up 7, 8, 9% a year, guess what? Coke's going to underperform. Because a lot of that upside happened in the last 12 months. Now the market goes down, they go up, okay, different story, but that's the point. Like what the analysts are actually saying today is, hey, they had a good year, but they're already kind of priced in their expectations. Now, go back, red, yellow, green, they have these marketing terms for buy, sell, hold. So basically buys are green, yellows hold, red sell, just to normalize. But here's the thing. If I go into Cowen or Jefferies, this analyst put a hold on August 27th. What's today?
28.
Okay, so that would be, today's 28th? So this would be yesterday? Okay, so go to Kevin. So Kevin has a big universe by analyst standard. He's covering 23 companies. Most analysts are about 10 to 15 because the whole point is you're a specialist, but he's a beverage industry specialist. Typically, these are teams of 3 people. You got Kevin, you got an MBA, you got a smart undergrad. That's it. So you can't have too many people doing coverage because you don't have that many people on your team. And your job is to know everything about these companies. And by the way, unlike you and me, I can't call the CEO of Coke and say, hey, let's talk about your business. But Kevin knows the CEO of Coke on a first name basis. And when Kevin calls the CEO of Coke, basically they say, what can I do for you, Kevin? And so they're talking to the CEO, CFO, and head of investor relations on a daily basis. By the way, what's Coke's big news? What's the new market that Coke announced last month that they're going into as a new way of growing their business? What's the big news at Coke? It's the big market. Everybody know?
Coffee.
They bought Costa last year. Nobody cares about that because coffee is also potentially a business that could be bad for you. And Starbucks is dominant. It's new. Alcohol. Coke is going into the alcohol business. They've been test marketing it for the last year in Tokyo. It was successful. Now they're going global with it. So think of it as like Fanta with tequila. Okay, so seriously, they're doing fruit-flavored soda drinks with alcohol infused in cans that they're targeting to your age, your generation. And that's their big market, right? It's not something you would have ever guessed that Coke would do, but they're slinging alcohol. It's like Disney going into the porn business. It's just not something expected. I'm not saying they are, right? But it could. You got to go find the next big thing because the problem is sugar's under threat. And try and figure it out. And so caffeine's under threat to some degree. So they're trying to find something else. Ironically, they're thinking about Monster Beverage as another acquisition, which makes no sense to me. It's even worse for you than Coke. But regardless, that's the things that you have to start paying attention to with these companies. But that's what these guys are doing. And then they'll be like, hey, Pepsi, are you thinking about alcohol? Hey, Dr. Pepper Keurig, are you thinking about alcohol? And they're writing the research, and they're giving their opinions to the analysts. And by the way, if you want to know about Kevin, you click on his little bio. This is his cell phone or office phone. This is his actual email address. And this is where he works in New York. And you are 45 motivated students looking for a job, right? And by the way, if you see a green dot next to his name, that means he's on the Bloomberg terminal, and you can actually message him through Bloomberg in real time. And because Bloomberg is a system of record, they generally respond to Bloomberg messaging because they have to. Until they find out that you're a student, they might block you. But how bad do you want a job? Okay, seriously. Like PEOP, people. Every Bloomberg member is in that directory with their Bloomberg account and their Bloomberg phone number. And until you're blocked, you can search that. And I can go in there and I can screen. I can say, show me every Maryland grad that works on Wall Street. Start dialing. How bad do you want a job? It's up to you. Anyhow, so back to this. Or show me all the undergrads that were here in the last 3 years that are now working on Wall Street. Might get more success with them than him. But regardless, that's not the point of today's story. So let's go back. These are the people that are writing the opinions. But the other thing they're doing, I understand the industry, is they're putting together a financial forecast. And they're doing Excel, because somebody's got to forecast. This is going back a long way to the first part of the story. Somebody's got to forecast those cash flows. These are the people, after they aggregate all that, forecast Coke's cash flows. Okay? EEO, Earnings Estimate Overview. This is the baseline forecast for Coke's financial performance into the future. Because it's the wisdom of the crowd, it's these 31 analysts uploading all of their spreadsheets to Bloomberg, and Bloomberg averages them. That's the consensus estimate. That's exactly how the consensus estimate is generated. It's just the average of what these analysts have to say. Right? And so I'm just telling you, it's the baseline. Everybody looks at this as the baseline. I don't have to agree with it, but it's probably not going to be dramatically far from this for a company like Coca-Cola, because this is what's going to be key to driving their price. So, long story short, that's annual. This is quarterly. And you can see how they're doing. Okay? So again, performance against expectation. This is expectation. The other thing you might want to consider for your assignments is Bloomberg also has, this is why you got to get certified, something called BI, which is Bloomberg Intelligence. And specifically, if you want to do it for the company you're on, BICO, BI on the company, BICO. And what Bloomberg does is they'll hire former sell-side analysts to work for them directly. And they don't actually do the buy, sell, hold opinions. What they do is they curate all the analyst information and they put the executive summaries into Bloomberg. So basically, this is an overview of what the analysts are saying in executive summary form. So if I'm trying to understand a company, understand their industry, why a thing is trading it is, good place to start. And if I want to look at the industry, same thing. This is the curated view of the analyst data on the beverage industry. So I'm thinking 5 forces. This is the data for my 5 forces. Because the analysts have to do the same thing. So Bloomberg is just looking through the analyst reports and saying, oh, here's the kind of what we're seeing trends, and they're aggregating on our behalf. And if you want this outside the lab, actions, export to PDF. Okay? All right. Cornerstone number 4, competitive advantage. Nothing lasts forever. It doesn't. Advantage is transient. So here's what that means. You're going to read about this in the book. We've already been talking about this. This is the first 3 chapters of the book. Basically, number 1, different industries are more attractive than others because of the industry conditions. So BICO can help you understand what's going on with those industries. And by the way, will they change, get more or less, or stay the same attractiveness over time? Number 2, ROICs decay. The best performing companies today will not be the best performing companies in 10 years. That's just data. Now, 1 in 4 might be in 5 years, but you're swimming against strain for the long term. It is not a surprise to me that GE, the most valuable company in the world in the year 2000, is struggling today. The world moved on. GE didn't. What are you going to do? It is not surprising to me that Apple today is starting to struggle. Right? It has nothing to do with Apple. It's just the world is moving on. It's just the way the world works. It's hard to keep up. And by the way, it's not going to be a surprise to me in 10 or 20 years that we're going to have the exact same conversation about Amazon. As good as Amazon is, It's going to be the back in the glory day conversation, sitting at the bar saying, wow, do you remember Amazon? They used to be the first original place to do this. So I'm just telling you, it's nothing against Amazon, it's nothing against GE, it's nothing against any of these other companies. It's Darwin, and Darwin happens. And we can't forget that when we're valuing these companies, because the average company does not maintain success for long periods of time. So with that in mind, growth decays even faster, which again should be obvious to finance people, but number one, because of law of large numbers. When you get to be Apple size and you're 220, 240 billion a year of revenue, you don't grow at 20% organically. If you do, you're growing the equivalent of one Facebook per year. That's not easy to do. So the fact that they're growing 3%, people are like, oh, they're only growing 3%. Well, when you get to $200 billion a year, try to grow at 20% without acquisition. And so that's the point. Same thing's going to happen to Google. Same thing's going to happen to Facebook. Same thing's going to happen to Amazon, is eventually their growth is going to slow because they're going to mature. We got to remember that when we're starting to forecast growth rates. Right? And to some degree, ROICs. All right, so I got to go through some hardcore stuff here because you need to understand some core principles that are, again, explaining the first 3 chapters of the book, but I'll at least give you some of the executive summary. This, when I talk about assignment number 1 and 2, and I say use principles during the class, this is core to some of the principles of this class. So we're going to start out with this hypothetical company that makes $100 million a year of no PAT or no plat. And those are fairly interchangeable terms. No plat's the McKinsey terms, net operating profit less adjusted taxes. No PAT, general term, net operating profit after tax. But it's basically EBIT after tax. So operating profit after tax. There's 2 things you can do with your profits. At the end of the day, there's only 2 things. You can either put them back in, that's called the reinvestment rate, or you can pay it out. It is completely surprising to me how companies overcomplicate this. Oh, what are we going to do? Let's buy back stock or pay dividend, or maybe we should pay off some debt or get rid of that commercial paper, pay out. Let's think about, should we do an M&A? Should we buy some plant, maybe inventory, R&D, reinvestment? Like there's only 2 things you can do. You either reinvest or you can pay it out at a very high level. So when you make profit, those are your 2 choices. And those 2 choices add up to 100% of those profits. Therefore, core ratios that we're going to use this semester, reinvestment rate, the percentage of your NOPAT, your profit after tax that you're paying out, reinvesting, and then the payout rate is the percentage of the profits that you're reinvesting. Returning investors. Get it fully backward. Get dyslexic there. Once more time. Reinvestment rate, percentage of the profits reinvested, payout, percentage of the profits being paid out, add the 2 together, 100% of your profits. Therefore, 1 minus the reinvestment rate equals the payout rate, 1 minus the payout rate equals the reinvestment rate. Okay? So mechanically, how would this work? So take this company with $100 million of profit and 50 of reinvestment and 50 of payout, just arbitrary to keep the math simple. Half reinvestment, half paid out. I want to talk about 2 things, free cash flow and growth. You are not worth the sum of your future profits because you're going to take some of those profits and you're going to have to reinvest them just to maintain what you do. And if you want to grow, you got to reinvest them to grow. So profit minus reinvestment does not have an accounting term. So we created our own term for that. It's called free cash flow. That is free cash flow. And that is the payout rate. The theoretical payout rate is your free cash flow because that's what's left after you have fully reinvested. That's the distributable cash. Okay? So here's the key. Free cash flow, profit after reinvestment. Number 2, G, little g, sustainable growth rate. Long-term growth rate into perpetuity, called G. Growth in earnings, proxy growth in sales, the same margin. So here's the point. Have a company with a 50% reinvestment rate. So it's in the last example, take half of the profits, 50 million, reinvest. New assumption, 10% ROI. You made 10% historically return on investment. You're going to keep making 10% in the future. Math is easy. So you'll still make your $100 million of profits. You'll make 10% on the 50 million that you just invested, 5 million more profits. So your profits next year will go from 100 million to 105 million. That's a 5% growth rate. That's G. Okay? Now, we can mechanically do it, or I can shortcut it for you. This is the shortcut. G equals the percentage of your reinvestment profits, 50%, times the ROI that you're going to make on those profits, 10%. If I reinvest 50 and I make 10 on the 50, I can grow at 5%. That is known as your sustainable growth rate. That is the rate at which you can grow without external funds. Anything beyond that rate of 5%, you need to borrow money or draw down your cash reserves. Right? Make sense? So we're analyzing Google. Also known as Alphabet. Okay, we go to RV. RV pure comparison. We go to custom. Now, here's the thing. I'm going to do something that's advanced because you don't have this in your database yet. I want you to do the assignment as I've already defined it. So you're going to have to do it this way, and then you're going to have to unlearn and relearn. But basically, this is the naive approach that's being taught by most finance faculty to people in the world when they talk about reinvestment rate. So here's the idea. Google's ROIC is what? Okay. Google's dividend per share is what? 0. Google's reinvestment rate is therefore what? What's 100% of 14.75? They can grow at 15% a year. Make sense? Anything more than 15%, they're going to need more money. But this is why it's naive, and it's funny how many sophisticated finance people don't understand this, because there's a problem with this definition in that invested capital includes non-operating assets, which have nothing to do with their search engine and ad business. Okay, have a bunch of cash in the bank, non-operating asset. Making money on that has nothing to do with selling more search engine AdWords. So here's the thing. One of the things you're going to learn how to do is strip out the non-operating assets to see, running at search business and other things, what is it really investing to do that? It's called operating ROIC. You don't have it in Bloomberg because it doesn't exist. You're going to put it in as a custom field. But I do. So if I add this column, which is called the operating ROIC, future homework, this is what they're actually making running their business day to day as an ROIC. %. So they're making 32% in the search business. They're making a couple of percent on their cash and non-operating assets. You average it out, you get 15. But the search business is actually doing much better, and they're actually churning out 35 cents per dollar per cash. So how fast can they grow? 32%. How fast is Google actually growing? EEO. Does Google need to borrow money? No, it does not. Not only will it self-fund its own growth through operations, it's going to throw the equivalent of a third of its profits into extra cash going up and up and up for the next 5 years. This is why some of these high-performing companies are generating so much cash, because they have huge ROICs, which gives them tremendous sustainable growth rates. You're going to understand exactly what I'm talking about in the next few weeks. But so this is not, it's more advanced, but follow along with me, core concept. Okay? So let's go back to the core concept. So that's the point. This is what sustainable growth is. Continuing on. It's your sustainable growth and your cash flow, right? And the key to the cash flow is got to do free cash flow, which is profit minus reinvestment. And so that leads to McKinsey's approach. This slide, I know it's kind of hard to see, has a lot of data on it. And unfortunately, I can't go full screen because when I do, it's going to kill the video that I'm recording. But long story short, Company A, Company B. Company A is the one we've been hypothetically talking about. Company B is another made-up company. These are just made-up companies right now in this example. Okay, and the key is, and this is actually one of the most important concepts of the semester for you to get what's on this slide, right? But it's basically this: you have two companies that start with 100 million a year in profit, identical profits. You have two companies that are both G's growing those profits at 5%, 100, 105, 110, etc. 100, 105, 110, etc. 1.05 to the whatever it is. Okay, it's going to continue. Both have the same cost of capital. Same profits, same G, same WACC. Will these companies be the same value? Will they have the same stock price? Given the data on the slide. And if not, which is worth more, A or B? I guess.
Company B,
Because,
the reinvestment rate is lower.
and therefore they get more. If they have less reinvestment, they get more what? Free cash flow. Because we said the value is based on the free cash flow. So what your attention should have shifted to is you should have looked it down here. I said that's the point. This is like the magic. People like, ooh, sparkly, profit. No, free cash flow. This is what you're generating. And B is generating more free cash flow than A for the same profit. Therefore, qualify, assuming they're not cutting corners, this is real, they're better, then this is why they will be more valuable. And they're more valuable, as we pointed out, because for the same profit, they don't have to reinvest as much. And the reason they don't have to reinvest as much is because they have a higher ROI. 20% versus 10%. They're better at what they do. But this is the key point. Two key points. Number one, if you have a higher ROI, you will generate more free cash flow at the same amount of growth. I'll say that again. If you have a higher ROI, by definition, you will generate more free cash flow for the same amount of growth. Mathematically, you have to. Here's the point. I don't have to spend as much when I make 20% on 25 versus 10% on 50 to make the same profits. Or if I invest 50 and you invest 50, and I make 20% on 50 and you make 10% on 50, I'll have higher profits. Either way, I win. Higher ROIC, as long as it's not cutting corners, like you just slashed and burned everything, right? Higher ROIC equals more free cash flow. Matter of fact, that's point number two. This is the McKinsey book. This is why McKinsey's good, and this is why McKinsey is more popular, in my opinion, in the valuation world. Because McKinsey's an ROIC-based valuation company. ROIC is free cash flow. It's just easier. Our accounting systems are not set up to do free cash flow. The average person doesn't know what free cash flow is, and it's hard to track. It's much easier to understand ROIC, and it's easier to track ROIC. They're the same thing. That's the approach you're taking this semester. ROIC-based valuation, which is free cash flow valuation. Same principles, rearrange math. And this is where I'm proving to you that ROIC is free cash flow. And then here's the point. At the same level of growth. What makes it tricky in the real world is the growth rates aren't the same. Because Google's growth rate, as you saw, is high double digits or high teens. It's like 17, 18%. And they have 35% ROIC, 32% operating ROIC, growing at like 18% a year. Well, Apple's ROIC is in over 100% a year. It's crazy when they make an iPhone for $400 and sell it to you for $1,000, how profitable that is. Okay? But at the same time, Apple's only growing like 3%. So that's the point. When you actually put that into the math, Apple, Alphabet, and Google are worth about the same. Because even though I generate more cash flow, I'm not growing it as fast. Versus I generate less cash flow and I'm growing it faster. So it's the combination of the two that's valuation. Just gets a little trickier to do the math. But the same growth rate, higher ROIC, by definition, more free cash flow. Okay? Which then leads to, okay, we got to value this. How do we value this? Companies last forever, perpetuity. That is the magic formula for stock price. It's growing perpetuity. That's all it is. Okay? Cash flow divided by R minus G. But that formula is fundamentally flawed. And it's what you've learned. It's what Wall Street uses. It's what's taught in all the textbooks. And it's fundamentally flawed. And that's the problem with that formula. And here's the flaw that McKinsey highlighted. I'm not saying one of the flaws is we're using 3 numbers to represent the entire future of a business. I mean, that's pretty much a simplistic way of thinking about it. That's what we do. But that's not the flaw. The flaw is this. That formula assumes that the IRR on future cash flows equals the IRR on current cash flows. Whatever rate of return you have never changes. So if I'm valuing a business that's going straight line up right now, it will never mature, and I will overvalue that business. And 10 years from now, we'll be like, how did that happen? How did we overvalue this company? It's the math, stupid. If we apply this to a cyclical business and put it at the bottom of a cycle, we'll undervalue that company because it will never improve. Because we'll take the bottom of the cycle, ROIC, and I'll just spit it out into perpetuity, and it just exaggerates the directionality of the current cash flow. And that's what Wall Street uses today because that's what business schools teach you. And there's nothing wrong with the math. It's just the flaw that the ROIC can't change, the IRRs can't change. So this is McKinsey's attempt to change this. This is called Key Value Drivers, KVD. This is core to your assignment. This is core to the book. This is core to what you're going to learn in this class and take with you to the real world and benefit you, is this formula change. The formula right is the formula left with substitutions. So here's what we're going to do. Free cash flow divided by R minus G becomes, free cash flow is profit times 1 minus reinvestment. And reinvestment, growth is reinvestment rate times ROIC. Therefore, reinvestment is growth over ROIC. Formula left, rearranged, becomes the formula right. Changed a couple terms. But here's why the key value driver is an incremental improvement. Instead of forecasting free cash flow, we forecast separately profit and ROIC. This ROIC is incremental ROIC. Translation, future ROIC, which can be different than current ROIC. Now, it's still one ROIC for the entire future of the business. So we need to make sure it's representative, but at least it can be different than the past. And that's the improvement in their key value driver formula. And that's why McKinsey's valuations are better than a lot of Wall Street banks. And it's basically because they've understood that the past doesn't always repeat itself, and everybody else missed this nuance in the textbooks. So, long story short, real world. So this is homework 2. So I'm going to go to the spreadsheet that you're going to have to build, because you got to use numbers to answer questions. You don't use numbers, you're not getting credit for those word assignments. Please use numbers. So you're going to be in the second assignment, you're going to be like, how do I use numbers for these principles? Remember what I'm about to do. So I'm not going to post this spreadsheet, but I'm posting the video so you can recreate it yourself. Don't be lazy. All right, business A, business B, hypothetical on the last few slides. That was going back here. And I said, which one was more valuable? And somebody said business B. Well, let's do the math. So there's 4 parts to the key value driver equation. That's this formula over here. What is the profit? So I want the upcoming profit, because I'm dealing with the future cash flows, this year's profit, times the G. I need my expected ROIC going forward into perpetuity. So I got my G into perpetuity, I got my expected ROIC, and I got my WACC that I'm going to discount it on. Those are the 4 parts of the formula. And if I know those 4 things, I'm going to get my value. So again, going back to this slide, here was the data. Expected profit was 100. Start with 100. Both companies were growing at 5% a year. ROIC of A was 10%. B was 20. And they both had 10% WACCs. And I asked which one was more valuable, and you guys said B. Well, here's the math. So putting in this formula with the correct order of operations equals left paren profit times left paren 1 minus the growth divided by the return, right paren divided by left paren WACC minus G, right paren, oh, did that wrong, equals profit times 1 minus growth divided by return divided by WACC minus growth. There we go. Billion, billion five. So the only thing I'm going to do is tell you it's worth 50% more. Intuitively, we knew it was worth more. I'm just translating it 50% more. Now, there's something out there called the PE ratio, the multiple of earnings that I pay for a company. What's the multiple or PE multiple of business A? Assuming they have no debt. What's the multiple of business A? What's their PE? What's their price? 1,000. What's their earnings? PE of 10. PE of 15. So that's the other key point. Multiples. I said this, referred to this in Monday's class. It's just rearranged math. It's not some alternative form of valuation. It is free cash flow valuation rearranged. So the way you should think about multiples, it's a shortcut. ROIC is proxy for free cash flow. Multiples are a proxy for free cash flow valuation. If you have a higher free cash flow valuation, you're trading a higher multiple. Key value drivers, what drives your multiples? They got to be right here. Growth and spread. So, scenarios. You understand these 4 scenarios, you understand the core principles of valuation. We're going to get more complicated, but this is the core. This will help you with all of your assignments. All right, number 1, and by the way, this is homework too. Expected profit doubles. Company A gets a big win. They double their profits overnight. What happens to their value? What happens to their multiple? When I hit enter, what's going to happen to the value? What's going to happen to the PE? Is the value going to change?
Value doubles and the multiple stays.
All right, let's see if he's right. Double, triple, company B, double, so this is called sizing. You're just bigger. One way to become more valuable is you just generate more cash. You're Walmart. You're Behemoth. All right? So you're bigger. But that doesn't make you better. I don't pay more for the earnings. I just have more absolute amount of earnings. So, absolute amount of profit doesn't change the PE. Must be something else. Must be the key value drivers of growth and spread. So let's talk about sustainable growth. You're Walmart and you go international. So instead of growing your sales and profits at 5% a year, you can now grow at 6% a year because you got all that growth in Asia and Latin America and Africa that Target does not because they just stay in the US. So Target has a better ROIC, but they don't grow as fast. Walmart now can grow its earnings at 1.05 to the whatever power, to now 1.06 to whatever power, higher growth rate into perpetuity. Now what happens to the value and the PE when you can grow an extra 1% a year CAGR? Does value go up? 100 becomes 106, 112, whatever, as opposed to 105, 110. Does the value go up? Does the multiple go up? Well, let's see how much. 6% per year, 7% per year, 8% per year, 9% per year. That's growth in EPS. That's growth in cash flow. Is anything changing? Maybe I made a mistake. I can make mistakes. 6, 7, 8, 9. Why is A not changing and B going up exponentially? Yes?
This is just a guess, but is it because for A, your ROIC will not be the same?
It's a good guess. Why does that matter? If the ROIC and the WACC are the same, what is that basically saying? Your spread 0, which means your NPV is 0. And if you do a bunch of NPV 0 projects, guess what you get? 0 NPV. See, common sense. That's exactly right. So that's the point. I like to call this the treadmill. You run really fast, you don't go anywhere, and eventually you get tired. And there are so many companies that I work with that are on the treadmill and they can't understand why. Because they're focused on their earnings, and what they're not realizing is they're putting all that cash right back into the business. There's no free cash flow, and their ROIs aren't all that great. Right? Versus B, which has the positive spread, when you throw the growth on that, you become exponentially more valuable. And I'll give you one I'm working with right now. It's called Merck. Right? Merck is a big pharmaceutical firm. I'll give them credit. They literally cure cancer. Their biggest selling drug is a drug called Keytruda, which cures cancer. Okay? So here's the thing. Go to Merck, US Equity, and I'm going to go to FA, which is historical results, as opposed to RV, which is comparative results. And I'm going to go to custom, create a custom, and I'm going to look at ROIC for the last 6 years for Merck, and I'm going to look at the WACC for the last 6 years for Merck, and the difference between their spread. And then I'm going to add the growth rate per year for Merck. So this is the spread, this is the growth. So how much spread times growth equals value? Tell me what their stock price is going to look like historically during that period. Before I even put up the stock price chart, you should be able to describe to me generally the way this chart's going to look. Is it going to go straight up like a line? Is it going to be flat? Or is it going to go straight down like a line? What's the graph of the stock price going to look like for Merck, given that historical data? What do you think?
Down.
Why down?
Because the spread is negative.
Spread is negative? Depends on the year, but potentially. Okay. Way down or just a little down? Like 45-degree down, 5-degree down?
6 degrees down.
Okay, 6 degrees, I like that. Kevin Bacon. So here's a real question. Actually, is it 2.87? I think the number's like 2.87 to Kevin Bacon or something like that. It's right around 3. We're actually connected to Kevin Bacon. But that's a different story, different day. So here's the point. Flattish is what he's basically saying. Not going straight up, not going straight down. Here's GP, graph price. Let's look at Merck stock price. Keyboard. There we go. GP. And here's last 5 years. Now, ignore the last year, because this will be 2000. Things have changed for 19. But that's the period we're talking about. It's flat. And as I'm saying, you will understand this in the next month, that by understanding these principles, you'll understand why the stock prices are doing what they did. And even like this, you'll start to know what to look for before you even see it. Right? And by the way, what's changed about Merck in the last 12 months? Well, if you go to EEO, look at revenue growth rate, which is now growing. And by the way, Merck is the sum of its drugs. So by industry, all the pharmaceutical firms has all the drugs in their pipeline forecasted by drug for the next 4 years, including early stage drugs, which are in clinical trials. Power Bloomberg. But look at the first one, Keytruda. 11 billion to 18 billion. They're getting $7 billion a year of just Keytruda. Keytruda is $100,000 per treatment, cancer treatment. So for example, 7,000 lung patients and 100,000 treatment is $7 billion of new revenue. They're the only game in town, very high margin. That's what's changing about Merck. Right? For the last 5 years, there's been a ton of money to get this drug to market. So terrible ROI, terrible free cash flow. Ironically, huge profit margins. Yet frustrated employees who are wondering why their stock options aren't going up. But again, very explainable, very understandable. This is the type of stuff you're going to learn. Scenario number 3. Reset. You are Apple. People aren't going to buy as many iPhones because you're mature. So instead of growing at 5%, you start growing at 3%. What happens to your value? What happens to your PE? Instead of growing at 5%, your growth slows to 3. What happens to your multiple and your value? Up, down, stay the same. See, I price you as if. ROIC is cash flow. Therefore, I generate 20 cents of cash and I grow 20 cents at a 5% CAGR. I realized I was too optimistic and I had to take 20 cents and grow it at a 3% CAGR. It's not worth as much. It's not an indictment against Apple. It's law of large numbers. When you get to be a $200 billion company, it's hard to grow very fast. And by the way, people are catching up on the innovation side to figure out what's next. So I'm just telling you, this is the third scenario. This is the expectation playing out. Scenario number 4. You have a negative spread. You're one of the automobile makers, and you're now in a terrible industry. What happens when you grow? Hey doctor, my head hurts. Why? I've been banging my head against the wall. Stop banging your head against the wall. Watch what happens when I go from 7 to 3 to 0 to -3.